We're going to start the review of our Chapter 17 assignments with Exercise 17.1, where we're going to calculate the total time in days for a note. So we're given the date of the note and we're given the due date, and our job is to figure out the number of days in between. So we will do a couple of these and then I'll save the rest for you to practice on. So I've copied a couple of them over to an Excel spreadsheet so that you'll be able to see how I did the calculation. So in the first note, it started May 4th and the due date of the note is July 17th. So we're going to start with the month of May. May has 31 days, and of those 31, 4 have already passed. So 31 minus 4 is 27 days. The next month is June. It has 30 days. And then we go to July 17th. So I'll put in the 17, and that gives me 74 days when I add up these days. In the next note, it begins August 17th and ends October 1st. So August also has 31 days, and we'll subtract the 17 here that have already passed. September has 30 days, and then October just has 1 here. We're going to October 1st. So the term of that note is 45 days. So next we go to exercise 17.2, and we're just going to calculate the interest there, and I also have that on a spreadsheet. You remember that your formula to calculate interest is the principal times the rate times the time. We'll enter 5,000 times 6% times 30 divided by 360. And that's going to give us interest of $25. Okay, I think we don't really need to go over any more of those. I think you guys can calculate interest pretty easily. So on 17.3, we are determining the due dates given the date of the note and the term of the note. So we'll move back over to our spreadsheet for those calculations. Okay, so we're starting in August, so the first step is to figure out how many days remain in August. So August has 31, and we're going to back out 12 that have passed. So we're looking at 19 days remaining in August. September has 30 days, and October has 31 days. So once we get all the way through October, we're up to 80 days. So our term is 90, and if we subtract the 80, we know that we've got 10 days remaining in that term, which takes us to November 10th. So November 10 will be the due date. Next, we have a note originating in or on September 1st, and it has a 60-day term. So we'll start with September, which has 30 days, and 1 day has passed, leaving 29 days remaining in September. October has 31 days, and that brings us to our full term, 60 days. So we don't need to go any further into the next month. Our term is up on October 1st. Excuse me, October 31st. All right, now we will move on to some journal entries. We're going to be journalizing notes received, renewed, and collected. On January 16th, we received a 30-day 6% note in payment for merchandise sale of $20,000. Okay, so we received a notes receivable, and it was for a sale, and it was for $20,000. Now remember, we're not ever going to enter the interest at the beginning of the note. Interest accrues or adds up over time, so when the note originates, it's just the principal amount. Next, on February 15th, we received $100 interest on the old note, and the old note is renewed for 30 days at 7%. Okay, so we've got two things happening. We're collecting interest income, and we're also renewing the note, and we're going to do that in a compound entry. So the first debit is for the cash, and it typically doesn't matter which debit you put first, but I'm just entering the cash collected from the interest. And I can also go down and enter the offsetting interest revenue while we're at it. And then the second thing we're going to do is to put on the new note and remove the old $20,000 note. So we know the principal is staying the same on these notes because there was no principal paid down. It was all interest. So we're debiting $20,000 for the notes receivable new, and then we're crediting $20,000 for the old notes receivable. Next, we received the principal and interest on the new February 15th note. Okay, so be careful not to go back to the original terms of the old note. We need to make sure that we're using the terms of the new note. And this note is 30 days at 7%, and the principal's $20,000. So that's $20,000 times 7% times 30 divided by 360. So that interest comes up to $116.67. Remember to always round to dollars and cents on your notes. And make sure and round properly, because you know that CNOW is not very forgiving for rounding errors. Okay, so we are collecting cash for the principal and the interest. The principal was $20,000 and the interest was $116.67. Now I need to take the notes receivable off the books because it has been cleared up, paid in full, and then I'm going to record the interest revenue. On the 19th, we received a 60-day 6% note in payment for an accounts receivable balance. That was for $8,000. So I'm going to put the notes receivable on. It said we received a notes receivable. And the credit tells what exactly that notes receivable was for. And in this case, we simply paid off, the customer paid off an accounts receivable with a notes receivable. So we've removed the accounts receivable from the books with the credit and put the notes receivable on with the debit. On May 18th, we received $80 interest plus $1,000 principal on the old note, and the old note is renewed for 60 days at 6%. Okay, so let's focus on what we received first of all. We received $80 in interest plus $1,000 principal. So we have cash of $1,080 and a new note. Okay, so we will debit cash for $1,080, and we've also received a new notes receivable. So the original amount of the note was $8,000, $1,000 was paid toward it. So the new note will be, well, not 7,200, 7,000. 8,000 minus the 1,000 principal. Then we need to remove the old note, which was at 8,000, and then record the interest revenue of $80 that we collected. Okay, so I know that I'm in balance here because this debit side equals 8,080 and the credit side equals 8,080. So before you leave the journal entry, make sure that it is in balance because all journal entries have to balance. On July 17th, we received principal and interest on the new May 18th note. Okay, so remember that new note was for $7,000 and it was for 60 days at 6%. So 7,000 times 6% times 60 divided by 360 is $70. So we received all the principal and the $70 interest in cash. So that's $7,070. We have a credit to notes receivable to remove the new note from our books. Here was the debit, and so here's the credit to remove it. And then we're going to enter the interest revenue for 70. Okay, next we will do number 5. In number 5, we are going to be dealing with discounted and dishonored notes. On April 6th, we received a 120-day 6% note in payment for an accounts receivable balance. Okay, so here's one of those cases where we've received a notes receivable to pay off an accounts receivable. So the notes receivable goes on and the accounts receivable is removed with a credit. On April 26th, the note that we just received was discounted at a rate of 7%. When a company discounts a note, that usually means that they don't want to have to wait the whole 120 days to get their cash for this note. Sometimes the company may need the cash. They may have a cash flow problem. So if the note is discounted, that just means that it's been transferred to the bank, it's been negotiated over, and the bank is going to discount that note and then give us the proceeds. So let's go over to the spreadsheet and figure out what the discount is. Okay, the formula for the discount is the maturity value of the note times the discount rate times the discount days. And maturity value, remember, is the amount of the principal plus the interest, what the note is worth once it becomes due. So in this case, our note was a principal of $3,000, and that $3,000, we'll come over and calculate the interest on it. It was a $3,000 principal. It had a 6% rate, and the term was 120 days. So that's times 120 divided by 360. Okay, so the interest on that note, the $3,000 note, was $60. So we'll enter the principal plus the interest of $30.60. The discount rate was given. It was 7%. And then the discount days is what we're going to have to spend some time calculating. So let's go back over to the problem. The note originated on April 6th, and it was discounted on the 26th. So 20 days passed on this note from the 6th to the 26th. If 20 days have passed, that means that 100 days remain. So 120 minus the days that passed is 100. So that's going to be our discount days. Okay, so we will now calculate our discount. It's going to be the 30/60 times the 7% times 100 divided by 360. So our discount on this note is $59.50. The discount that we've calculated is what the bank keeps. What's important to us is the amount of the proceeds. That is the number that we need for our journal entry. So the proceeds is the maturity value less this discount. So we will calculate that by taking the 30/60 maturity value and subtracting out the $59.50 discount. I need to blow that up so you can see it. So our proceeds are $3,000.50. Now we're going to go over and enter that in our journal entry. Okay, so cash is $3,050. That's our proceeds. That's what we got once we transferred the note over to the bank. Okay, we no longer have the note, so we need to remove the notes receivable from our books. So this is the note where it was debited, and then we're crediting it to remove it. Now, the difference between the proceeds and the principal is 50 cents. So since the proceeds are higher than the principal, we have an interest revenue. Had the cash amount been lower than $3,000, we would have entered an interest expense as a debit. On May 3rd, we received a 30-day 7% note in payment of an accounts receivable for $900. So we'll make the same entry we did before. We'll add the notes receivable to our books with a debit, and then credit accounts receivable to remove the old accounts receivable that was satisfied with the note. Then on June 2nd, the 930-day 7% note is dishonored. So that's not a very difficult entry. You just need to calculate what you would have received had that note been paid. So it's 900 at 7% for 30 days. Okay, the interest on that is $5.25. So had we collected on this note, we would have collected $905.25. And we would normally debit cash, but we're not receiving cash because this note was dishonored. They've told us they're not going to pay us. So we're debiting accounts receivable for $905.25. All right. Then we need to remove the note. So we're going to credit the notes receivable for $900 and then credit interest revenue for $525. Okay, so the note no longer has its legal status, so we're going to remove it from our books, and we're going to record the interest revenue that we've earned, but however have not collected. Now on the 5th, the dishonored note is paid plus 7% interest on the maturity value. Okay, so let's figure out how many days we're going to get interest on this June 2nd note. So from June 2nd to the 5th is 3 days. So we will earn $905.25 at 7% for 3 days. So if I put that in the calculator, $905.25 times 7% times 3 divided by 360, that is 53 cent interest that he's given us in addition to the 905.25. So 905.25 plus 53 cents is 905.78. So we've collected cash, and accounts receivable needs to be removed because it's been satisfied for the 905.25, and then we're going to record some additional interest revenue of 53 cents. Okay, next we're going to look at accrued interest. Remember, accrued interest is interest that has added up. Accrued just means added up. So we have two notes that we need journal entries for at the end of the period. The first one is $4,000. It's a 90-day note. It's at 7%, and interest has added up for 15 days. Okay, and they've already calculated the amount here, but we'll just calculate it again to check their figure and to get some practice. So 4,000 times 7% times 15 divided by 360. Okay, that's 1167. So remember, when you're accruing interest for the year-end adjustment, don't go back and use the original term. Always use the number of days from the date of the note until the end of the year. The next note is for $7,000. It's a 60-day term. It's at 6%, and interest has added up for 18 days. So that will be 7,000 times 6% times 18 divided by 360, and that's 21. So the total interest that's added up but has not yet been paid on our notes receivables is $32.67. So to make sure that we are including all the interest revenue that has been incurred but not received at year end, we need to debit accrued interest receivable and credit interest revenue for the $32.67. For the next problem, we'll go ahead and skip on down to, let's do problem 11. It has a lot of different scenarios in it that we can get some good practice with. Okay, so March 1st, we sold merchandise on account. Okay, so that's pretty easy. We've done sales before. So this is accounts receivable and sales. 5,000. Okay, next on the 20th, G. Perez gave a $5,000 90-day 6% note to extend the time for payment. Okay, so the 30 days is up on this accounts receivable, so Perez is giving us a $5,000 90-day 6% notes receivable. Okay, so we are going to debit notes receivable for the principal amount, and then credit accounts receivable because that accounts receivable was satisfied with the notes receivable. So the accounts receivable is now removed from the books. On the 30th, G. Perez's note is discounted at Commerce Bank at a rate of 8%. Okay, so before we can discount this note, we need to know the maturity value and the discount days. So the maturity value is 5,000 times 6% times 90 divided by 360. So interest is 75. So our maturity value is 5,075. The discount days, remember, are the days remaining on the note. So the note originated on the 20th, we discounted it on the 30th, so 10 days have passed, and if we subtract the 10 days from the term of the note, that means 80 days remain. So our discount days are 80. So to calculate the discount, we'll take the maturity value of 5,075, multiply times the discount rate of 8%, and then times the discount days of 80 divided by 360. So our discount is $90.22. Okay, so remember, we're not really concerned about the discount. We need to know what the proceeds are. So to get the proceeds, which is what the bank is giving us for this note, I'm going to take the 5,075 and subtract the $90.22 discount. And so our cash proceeds are $49.84.78. So that's 84. Okay, and we're going to remove the notes receivable at its principal amount. Probably might be better off doing that down here because I see we're going to have interest expense. And then on this line, we're going to fill in the interest expense. Notice that the cash we received is less than the principal. So our interest expense on this discount will be $15.22. Okay. Now on April 20th, we received a $3,000 60-day note from Larson in the payment of a sale of merchandise. So this note we received directly for a sale, and that was for $3,000. On May the 5th, Larson's note is discounted at Commerce Bank at a discount rate of 7%. Okay, so once again, we need to know the maturity value and the discount days. All right, we'll start with the maturity value. The interest on that note is $3,000 times 6% times 60 divided by 360. So the interest is $30, so our maturity value is $3,030. The discount days. Okay, the note originated April 20th, and we discounted it on the 5th. So April has 30 days and 20 past, so that means 10 days in April plus 5 in May. So 15 days have passed on a 60-day note. 60 minus the 15 days that passed to leave us 45 days remaining on that note. So now we can calculate our discount. The maturity value is $30.30. We're going to multiply that times the 7% discount rate, and then multiply that times 45 divided by 360 days. So the discount is $26.51. In order to get the proceeds, we're going to take the maturity value of $30.30, subtract $26.51, and we'll get proceeds of $3,003.49. Okay, so cash is $3,003.49. We're going to take off our note because it has been negotiated. And then the difference between these two figures is the interest revenue. So we did get a little bit more than our principal amount, so we will have interest revenue on this transaction. Next, on June 19th, Larson's note is dishonored. Now that's the note that we just discounted at Commerce Bank. And since Larson's isn't paying Commerce, Commerce is looking at us to pay that note. They're expecting to collect $3,030. So we're going to have to pay that $3,030 back to Commerce Bank plus a $40 fee. So we'll come down and we're going to enter an accounts receivable for Larson for the full amount that we're having to pay Commerce Bank. And then we'll credit cash because of course we're having to pay it. And notice that we've put an accounts receivable on for Larson. We can't put a notes receivable back on there because it's not legal yet. Nobody has signed anything. So it just goes back on as an accounts receivable for the maturity value plus the fee. Then on the 31st, Larson's dishonored note is collected. Larson pays Marino the maturity value of the note, the $40 fee, and interest at 6% on the maturity value plus the bank fee. So in other words, they're giving us 6% on the full $3,070 that they owe us. So we know the 30/70, we know the rate, we need to know the amount of days. So we'll start here. He should have paid on June 19th. So in June there are 30 days and 19 have passed, so there were 11 days left in June, and then there were 31 in July. So for 42 days he is going to pay us interest at 6%. Okay, so that's the 30/70 times 6% times 42 divided by 360. So that's $21.49. So we're going to collect in cash the amount that he owes us plus the $21.49, which comes out to $3,091.49. We're going to remove the accounts receivable because it's been satisfied, and then we will record the interest revenue that we just collected for those 42 days. Okay, on August 1st, we sold merchandise on account to Bauer for $5,600. Okay, that was just a simple sale on account, and that amount was $5,600. On August 12th, Bauer paid $400 and gave a $5,200 30-day 5% note to extend the time for payment. Okay, so on the 12th, we're collecting $400 from Bauer, and he is going to satisfy the remaining $5,200 of the accounts receivable with a note. Okay, so we'll record what we collected, the cash at $400, and then we collected a notes receivable at a principal of $5,200, and then we will remove the entire accounts receivable because it has been satisfied. On September 11th, Bauer paid $400 plus interest and gave a new $4,800 60-day 6% note. So he has renewed this note and has given us part of the principal and the interest that was owed. Okay, so the original note was $5,200 times 5% times 30 divided by 360. So that's $21.67 in interest. We had to calculate the interest ourselves and add it to the $400. So we received cash for $421.67. We also received a new notes receivable of $4,800. Remember, he paid us, it was $5,200. He paid us $400 in principal, so now the principal of the new note is $4,800. We're going to remove the old note, which was $5,200, and then we will record the interest revenue, which was $21.67. Okay, then on the 26th of September, Bauer's note is discounted at Commerce Bank at a discount rate of 7.5%. Okay, so when we discount a note, remember step one is to calculate the maturity value. So we discounted a $4,800 note that had a 60-day term at 6%. So 4,800 times 6% times 60 divided by 360. So the interest was $48. So the maturity value is 4,800 plus 48, 48. Now that amount was discounted at 7.5%, but we now need the discount days. So that's the number of days from September 11th to September 26th. So if we subtract out 11 from 26, that is 15 days. So if 15 days have passed on a 60-day term note, that means we've got 45 days remaining on that note. So that will be our discount days. So maturity value 48.48 times a 7.5% discount rate times 45 days divided by 360 is $45.45. So our discount is $45.45. And we're going to subtract that from 48.48, our maturity value, and we'll come up with cash of $48.0255. So that was the $48.48 maturity value minus the $45.45 discount. Okay, then we will remove the notes receivable, which originally was $4,800. That was this note right here. And now we've got interest revenue from that discount. On November 10th, Bauer's note is dishonored. So the $4,800 note that we just discounted has been dishonored. Bauer did not pay the bank, so we are going to have to pay the bank in their place, plus a $40 bank fee. So the maturity value was $48.48. We have to add the $40 fee. So we are going to now enter an accounts receivable for Bauer at $48.88. And then we have to write the bank a check for $48.88. Next and last, we have a dishonored, or Bauer's dishonored note is collected. Bauer pays Marino the maturity value of the note, the $40 bank fee, and interest at 6% on the maturity value plus the bank fee. So the maturity value plus the bank fee was $48.88. He's paying 6%, and for the number of days is from November 10th to December 15th. So there are 30 days in November and 10 have passed, so there are 20 days remaining in November, and in December was 15, so that's a total of 35 days. So that will be times 35 divided by 360. So he is paying an additional amount of interest of $28.51. Okay, so our cash is the $48.88 plus the $28.51 in interest. So we're receiving cash of $49.16.51. Then we're going to remove the accounts receivable that we put in when it was dishonored. And now we will record the interest revenue of $28.51.